Hey everyone, welcome back to Corporate Decoder. Today, T. Rowe Price Summit Funds Inc. just filed their semi-annual shareholder report, and I'm seeing some interesting trends in money market fund holdings. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a snapshot of how a large money market fund, the Cash Reserves Fund, is positioned and performing. It details where their money is invested and how it weathered the last 6 months. Let's dive into the heart of this report, which is the financial health and investment strategy of the Cash Reserves Fund. This fund is basically a way for people to park their money safely while earning a bit of interest. Its main goals are to keep the money safe, make it easily accessible, and then try to earn as much income as possible without taking big risks. Here is a breakdown of what the fund invested in as a percentage of its total assets. This tells us about its strategy. Variable rate demand notes made up a big chunk, about 24%. These are basically short-term loans that are tied to interest rates. They offer a bit of protection because the interest rate can adjust, and you often have the option to get your money back on short notice. Next, we see us Government Agency Repurchase Agreements at 21%. These are essentially very short-term loans where the fund gives cash and gets us government securities as collateral. It's a very safe way to earn a little bit of interest for a very short period. They are backed by government assets, making them quite secure. Then there are certificates of deposit, or CDs, making up 17.9%. These are time deposits with banks. You agree to leave your money in the bank for a certain period, and in return you get a fixed interest rate. They are generally considered low-risk investments too. Financial company commercial paper accounted for 15.4%. This is essentially short-term debt that large financial companies issue to raise money for short-term needs. Like managing their daily operations, it's like a company IOU that matures very quickly. Non-financial company commercial paper comes in at 9.5%. This is similar to the financial company paper, but it is issued by non-financial companies such as large corporations. Asset-backed commercial paper is 5.4%. This is a type of short-term debt that is backed by pools of assets like car loans or credit card payments. It's a bit more complex than standard commercial paper. Then we have a category called Other Instruments at 2.4% and Other Asset-Backed Securities at 1.6%. These are just other types of investments that don't fit neatly into the other categories. Insurance company funding agreements are at 1.4%. These are basically agreements where the fund lends money to an insurance company and the insurance company promises to pay it back with interest. You might think of it like a very high quality IOU from an insurance giant. Finally, short-term and other investments make up the remaining 1.4%. This means the fund is diversified across a lot of different, generally safe, short-term debt instruments. Now, let's look at the size of this fund. It has total net assets of over $5 billion. That's a massive amount of money, and it holds 207 different investments. That means the fund is spread out across many different companies and types of debt, which is a good sign for stability, especially for a money market fund where safety is key. Let's see who the fund is lending its money to, or what companies it's investing in. These are the top 10 holdings and what percentage of the fund's assets they represent. BNY Mellon is the largest holding at 13.1%. This means a significant portion of the fund's money is invested in some form of debt or instrument connected to BNY Mellon. Credit Agricole comes next at 5.9%. Royal Bank of Canada is at 2.0%. North Texas Higher Ed Auth is also at 2.0%. This refers to debt issued by a higher education authority, likely for projects related to universities in that region. Australia and New Zealand Banking Group is at 2.0%. BNP Paribas Securities is at 2.0%. California PFA, which stands for Public Finance Authority, is at 2.0%. Cook County is at 1.6%. This is likely debt issued by the county government. Alaska HFC State Capital Project is at 1.6%. This refers to debt related to capital projects in Alaska, likely an infrastructure or development initiative. And finally, Svenska Handelsbanken at 1.6%. What's interesting here is the mix of very large financial institutions and government or quasi-government entities. This suggests a heavy focus on very low-risk counterparties, which makes sense for a money market fund aiming for capital preservation. Now, let's look at the financial performance itself. For the 6 months ending the 30th of April 2026, the fund generated an investment income of over $99 million. That's a pretty good chunk of money from investments. After expenses, the net investment income was around $89 million. So the fund is definitely making money. They also had a small net realized gain on securities, which was about $33,000. This tells us they are selling some investments for a bit more than they bought them for. Overall, the increase in net assets from operations was a solid $89 million. This is the profit the fund made during this period. Looking at the balance sheet, the fund's net assets are a massive $5 billion. This is the total value of all the investments and cash, minus any liabilities. And importantly, the net asset value per S-share is exactly $1. This is typical for money market funds. You put in $1 and you expect to get $1 back, plus any interest earned. The goal is to keep that share price stable at $1. This table shows the total return for different periods. For the 6 months ending the 30th of April, 2026, the total return was 1.74%. This is the actual growth of an investment, including reinvested earnings. Over a full year, the return was 4.24%, and before that, it was around 5.22%. These returns are modest, which is expected for a safe investment like a money market fund. It's not about getting rich quick, but about keeping your money safe while earning a decent, albeit small, return. The gross expenses before any waivers were 0.40%, and the net expenses after any adjustments by the management company were also 0.40%. This is quite low for managing a fund of this size. It means the management company T. Rowe Price Associates is efficiently running the fund and keeping costs down for investors. The net investment income, as a ratio to average net assets, was 3.52% for the 6 months. This shows how much income the fund is generating relative to its size. The report mentions the fund's investment objective, preservation of capital and liquidity, and consistent with these, the highest possible current income. This is the classic money market fund statement of purpose. They also note that it intends to operate as a retail money market fund and has the ability to impose liquidity fees if redemptions get too high. This is a safeguard to protect remaining investors during stressful market conditions. Going back to the investments, the report details the specific variable rate demand notes. For example, to raise a note from AHI Fund Defru maturing May 7, 2026 with a rate of 3.77%. Then to raise another from Alaska HFC, a state capital project bond also maturing on May 7, 2026 with a rate of 3.72%. You can see there are many similar notes from various entities like California PFA, Charlotte, and Colorado Housing and Finance Authority, all with similar short-term maturities and rates tied to prevailing interest rates. This highlights the fund's strategy of holding highly liquid debt instruments. For us government agency repurchase agreements, we see large transactions with major institutions like BNP Paribas Securities, BNI Mellon, and Credit Agricole. For instance, there is a repurchase agreement with BNI Mellon for over $662 million. These are backed by US government securities, offering a high level of safety. Under certificates of deposit, we see a significant amount invested in Eurodollar CDs, like one from Australia and New Zealand banking group for $75 million. There are also many Yankee CDs, which are US dollar denominated CDs issued by foreign banks in the US market. It's a very diverse list of large, well-known banks. For financial company commercial paper, we see a long list of short-term debt from various banks and financial institutions like ASB Bank, Bank of Montreal, and Commonwealth Bank of Australia. These are all short-term instruments, typically maturing within a few months, essential for maintaining liquidity. In the non-financial company commercial paper section, we see holdings from companies like AdventHealth, Advocate Health and Hospitals, and Toyota Credit. Again, these are short-term debt instruments showing the fund's diversification across different types of issuers. Looking at the expenses, the investment management and administrative fees payable were around $1.7 million. This is for the 6-month period. Given the fund's size, this is a relatively small amount, confirming the low expense ratio we saw earlier. The report also includes a section on the approval of the investment management agreement. This is a standard part of these filings where the fund's board of directors reviews and approves the contract with the investment advisor, T. Rowe Price Associates. They considered the services provided, the fund's performance, and the costs. They concluded that the fees are reasonable and that continuing the agreement is in the best interest of the shareholders. They noted that the fund's contractual management fee ranked in the 5th quintile for costs compared to similar funds, meaning it's on the higher side for contractual fees. But the actual management fee rate ranked in the 5th quintile too, and total expenses were in the 4th quintile. This suggests that while the stated fee might seem high, the actual expenses paid by investors are closer to the average. This section reiterates the board's thorough review of the advisory contract. They looked at the quality of services, performance comparisons against benchmarks and peer groups, and the costs involved. They seem to have concluded that the advisor provides good value for the fees charged. Overall, this filing paints a picture of a very stable, managed money market fund. It's heavily invested in low-risk, short-term debt instruments, primarily from large financial institutions and government. Related entities. The fund is large, its expenses are low, and its returns are modest but consistent with its goals of capital preservation and liquidity. The management seems to be doing a good job of keeping costs down and the fund running smoothly. The main takeaway is that this is a very conservative investment focused on safety and steady, albeit small income generation. Alright, that is our breakdown of T. Rowe Price Summit Funds, Inc.'s latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.